Welcome to Multifamily Rockstars. If you are new to apartment investing or already experienced, you will enjoy this show. You will hear from the leading experts in multifamily real estate so that you can be a better owner, operator, and investor. Real people, real stories, life-changing. And now, your host, Ryan Christopher Nunes.
Welcome to today's show. Today we have Michael Becker. Michael is a principal at SPI Advisory and heads SPI's Dallas, Texas office, where he oversees 6,000 units, $750 million of assets, all in Texas. Michael worked in commercial real estate banking for 15 years and has originated and managed numerous portfolios of permanent and bridge loans in all major asset classes. Michael is a lifelong resident of North Texas. He is married and has 2 young children. Michael, welcome to the show.
Hey, thanks for having me on. Appreciate it.
Awesome. Well, let's jump right in. So, Michael, walk the listeners through your background.
Yeah, as you referred to, my professional background really was in commercial real estate lending. So I was a longtime banker, lent on all the major income producing asset classes. So I have a background lending on office, industrial, retail, and then the last 6-7 years of my banking career, all I did was multifamily lending. It's kind of how I got into it. So I was making loans, many loans, especially kind of going into and then coming out of the last recession that we got out of about 12 years ago. And kind of through that process, just realized I was on the wrong side of all those deals. Kind of better to be the borrower than the lender. So went out, started doing something about it, and geez, what are we, 7-8 years ago now? I guess started and went out on my own, started buying, or I guess really 9 or 10 years ago, started buying like some single family homes. Did 16 rental houses kind of one at a time, realized it wasn't very scalable. So then transitioned into the large scale syndications about 7-8 years ago. And like you said, we've done about a little over 10,000 units. We currently own about 6,000, should be closer to 5, but COVID-19 stopped a few sales here recently.
Sure.
So we have about 6,000 units, predominantly in Dallas-Fort Worth and the Austin markets.
Awesome. There's a lot of listeners that want to be like Mike kind of watching what you're doing in terms of how you're managing your assets and just, how you're communicating to investors and the like. So just walk us through what you're doing during this COVID-19 crisis, both at your assets and with investors.
I think first and foremost, we got to kind of focus. The first thing we do is really kind of focus on life and safety at the asset level. Some of the things we did in kind of mid-March when all this was starting to really kind of hit was shut down the offices, went to this kind of virtual leasing, or you have to lease kind of by appointment, having all our amenities shut down, making sure we did our best to get the PPE, keep hearing all about on the news, trying to make sure we got masks and gloves and things for our, in particular, our maintenance guys that have to go in and do work orders and the like. So it's kind of first and foremost, and then, how to do our best to kind of communicate with the residents as well. On the ownership side, kind of late March, we do our distributions on 15th of the month. So we had already kind of scheduled our March distributions right as all this was kind of going down. So we paid out in March, but we notified everyone starting in April forward, we're going to suspend all distributions, really wanting to make sure that we preserve our asset, preserve the future ability to maintain the asset. So keeping as much liquidity in your entity was critical. So we focused on, preserving as much cash as we could. We also stopped any sort of voluntary upgrades and capital projects that weren't, kind of past the point of no return. So any units that were in progress, we kind of finished off the upgrades, but stopped all new vacancies. So any new vacancy that wasn't upgraded would just get that basic kind of make ready turnover, clean the carpets, paint the walls as needed, but not really spending money to swap out appliances and fixtures and the like to try to further contain costs. We had a couple projects that were just about to set to go. I got the bids, so we're just about to sign them to do some major carpentry and exterior paint job on two different properties for a few $100,000 each. So those got kind of put on the shelf as well. And then we went into the great abyss of we didn't know what April collections were going to look like 30 days ago. So we were just really kind of unknown. So communicated all that to the investors. Then as we got into April, pretty much on a daily, if not every other day basis, from starting about the 4th of April forward, I've been giving like daily collection updates pretty much to all our investors to talk about what our scheduled rents are, what our collected rents are, the outstanding amount, the percentage. And then I've been doing that on a regular basis. So really the last 3 weeks, I feel like a news reporter. All I really feel like purpose is kind of reporting the news to everybody about kind of how we're collecting. And then here we are on the 22nd of April as we record this. And I sent the daily email out. So portfolio wide, we're about 3.5% delinquent. About 95.5% of our rents are collected, scheduled rent. So that's great. So our portfolio wide is about 93 occupied. There's some assets that we kind of just recently bought in the middle of repositioning. So those have a little bit lower occupancy, and then some of the more legacy assets a little higher. But, so all in all, with about 7% physical, about 3.5% collection loss, we're somewhere in the low 90s at the end of the day of economic occupancy, or about 10% economic vacancy. And if you had told me this number 30 days ago, I'd have been jumping for joy. This is far exceeding our expectations, our worst fears when everything first started hitting. Going forward in May, I don't really know exactly what to expect. My current kind of base case is we'll have somewhere between a 50 to 100% decline in collections, meaning if I finish, I think we finished about 3% collected, so I would expect somewhere between 4.5% and 6% delinquency. 3% delinquency in April, so about 4.5% to 6% in May in delinquency. And ask me 30 days, and I'll see how smart I am. So it's a guess, but it's kind of relatively educated guess, kind of seeing that some of the programs with the extra unemployment, the stimulus checks, those are really kind of supporting our tenants for the most part to be able to pay their rents.
No, that's great. I'm sure people are taking notes. And then in terms of, what advice do you have for investors and operators during this time? People that, own assets, or people that have been passively invested?
If you're passively invested, I don't know if there's a whole lot to do, but kind of just hang on. But, sponsors, leads of deals. Really, I think kind of following, obviously I'm doing this for a reason. I think it's the right thing to do, but, making sure, you're communicating with all the stakeholders. Yesterday I sent every one of my lenders a collection update as a close of business the day before. So, hey, here's our scheduled rents, here's our collected rents. So each one of my lenders know as of yesterday where I stood. And I'm going to try to communicate to them, probably twice a month, kind of with collection updates. So we'll get another update early May when we kind of get the final collection numbers. So making sure they're aware of it, because they're your largest partner in this deal, and in most cases is going to be your lender. Communicating with your investors, because you have your investors' money. So one of the things I always like to say is when people invest with you, they give you their money, and you have it. If you don't communicate with them, they think you stole their money, right? So communicate. That kind of puts everyone's got a lot of anxiety. Everyone's got a lot of emotions right now. So I think the constant, frequent communication provides some calm and some sets of facts in an uncertain time. So whether it's good or it's bad, I think communicating with people and you don't blindside them. Those that put their head in the sand with their lender or their investors, I think they're going to kind of wake up and be in a war of a hurt. Because one day your problems are going to go away. There's if they're a really big problem and you're surprised your investors or your lender, the outcome probably not going to be as good. But if you communicate along the way, maybe your lender has some resource for you they can offer that might be able to help you out. So I think those are the things, and then doing the right thing on the site level, protecting the staff, protecting the residents, and we're doing a lot of payment plans for the residents, where historically in Texas you wouldn't take partial rent payments, but now there's a eviction moratorium through the end of this month, through the end of April, and then practically speaking with all the municipalities, you're not going to be able to get someone out for another month or two at the best case scenario. Sure. So working on payment plans where historically you wouldn't take partial payments. Now we're happy to take $200 this week and $400 next week, or whatever it is. Just kind of trying to be compassionate with everybody along the way, because these residents have real life things they're going through. And they just simply lost their job through no fault of their own. So, the best we can work with them, we will, and make sure that all the resources the government are throwing at it, that they're aware of it and have the tools to know where to go apply for unemployment or get the stimulus check and things along those lines.
Yeah, no, that's great. I appreciate that. And so how does this change your outlook for multifamily?
I think you got near term, medium term, long term. Near term, obviously everyone's kind of in a foxhole right now, hunkered down, trying to figure all this out. I just think really everyone's kind of hitting the pause button on everything. As I kind of mentioned in the intro, we had two deals fall apart. Really, three deals fall apart. We had two deals that were in escrow. That one was 2 days away from closing, and the buyer's lender froze up, and they couldn't get their financing, and the deal blew up. So we're supposed to close the 19th of March, and on the 17th, or St. Patrick's Day, their lender froze up. So that was a bad St. Patrick's Day, and so that was a challenge. We had another deal. We just got an escrow. That was a smaller deal we owned around. That one fell out. It was like a week or two in escrow. We got an escrow early March. And then we had a deal on the market that was going really well, a lot of interest, a lot of tours, and all of a sudden just like dried apart. We got a couple offers in that were well below the prior expected range. And since we're not in any sort of distress, we don't have a loan maturity, we're pretty well capitalized. The deal is 95% occupied. So we're not in any reason to go sell the deal. And that's what I kind of think most people are going to now see. I mean, you hear other people talk that I think a little bit less informed, saying now's the best time to buy. Well, now would probably be an okay time to buy, but one, there's no deals are going to get done because anyone that's not in distress wouldn't want to sell in an environment like this. Two, the people that are in distress, they can't get foreclosed on for a long period of time. So they're going to not, the lender can't go sell the deal. They got to kind of put their head in the sand. So it's going to really probably take, at minimum, probably the start of the third quarter before you see the first deal or two kind of come out of this. And it's going to be a real small number. And I think maybe the fourth quarter will see a little bit more. And then probably in 2021, the first half, we might start seeing some more of these type of deals. It just takes a while to kind of work through the system, and then obviously I think multifamily is going to be much better positioned along with industrial to weather this relative. Obviously hospitality is a complete bloodbath going from, 80-90% occupancy to like 2 or 3% occupancy. And retail's kind of behind that. So, there'll obviously be more opportunity in those asset classes, a little less in the multifamily. And I do think, there'll be some opportunity. I really think, the intermediate to long term, I don't think it's going to be terrible in the multifamily space. I think where there will be stress, I kind of think of it like I would use the barbell analogy. You got kind of both ends of it. You got the very top of it. So a brand new deal, just delivered 10, 20, 30% occupied, kind of the middle initial lease up. That deal is going to have a really hard time getting demand in the front door. It's going to be really slow. They're going to be in a bridge loan with their construction loan, with a shorter maturity, generally speaking. So they're going to have some stress there. So I think there'll probably be some opportunity in that segment. Then on the opposite end, what the Class D properties that we've all been calling Class C for a while, but they're really always been Class D, that are in a high crime area that, have a less experienced sponsor on them, that maybe put a high leverage bridge loan on it, that maybe was in the middle of a reposition where they were in the 80% occupancy range or something like that, because they've been trying to renovate units, push rents. They kicked a bunch of people out. So now you're 80%, and then your collections go, I'm at 96+%, and then the workforce housing is lower than that. And if you're in a high crime area, it's even lower. So if you're only collecting 80% of a 80% rent roll, then you start having debt service issues, especially if you higher leverage. So I think those areas will have some issues, and the grand top of the market will have some issues. But the middle swath, if you don't have a high leverage loan and you're well capitalized and you have good management in place, and it's got all the basics that I've been talking about for the better part of 5 years on our podcast. If you would have done all those things, I think generally speaking, those people will survive this okay.
Sure.
And then with the amount of money everyone's printing, the long term is, I think if you survive the first year of this, through March of next year, you'll make the next 10 years. And 10 years from now, with the amount of money they're printing, I can't see any way there's not massive asset price inflation. So people that own real things like apartment complexes or even the stock market, I'm shocked the stock market's not lower, and it's simply directly correlated to the amount of money the Federal Reserve is injecting in the system. They're going to create a lot of inflation. So I think if you're going to hold on your assets for 10 years, you're going to be fabulously wealthy, but you got to survive the next 12 months to get to the next 10 years.
Sure. So, in terms of your acquisition strategy, are you underwriting deals now, or just things on hold? And, what things would you look at?
Yeah, I mean, we're trying to see whatever little inventory is on the market or being talked about. We're trying to see everything. We're trying to stay in motion, but I fully don't expect anything to actually transact in our world. Really, the best case scenario, third quarter, there's just nothing that's going to transact in the second quarter. The capital markets are frozen. Most of the lenders on a wait and see stance. One of the small deal that we were in escrow for about a week before it blew up, that lady, the buyer, started a loan. We actually were on a bridge loan. The only loan I have recourse on was that little deal because we own 100% of it. So we're taking over their Freddie Mac loan and refinancing it, and that's the only way that we're able to get the deal done. So we're actually going to do it, but they're going to put 12 months of PITI, principal, interest, taxes, insurance, escrows. So it's really going to take a lot of money out of pocket. So if you're trying to do a new deal, have really tight loan standards, have all these additional escrows, it's going to make a lot of these things look bad. And Fannie and Freddie really don't own liquidity in the market. And Fannie and Freddie don't loan on distressed assets because they want to have stabilized values. So until the bridge lenders and local banks start loaning money again, it's going to be pretty tough to do anything that requires new debt. So it's going to take a little while for it to kind of work out. So I'm hopeful we get another deal or two done in 2020. It'll be at the end of 2020. Certainly won't be in the middle part. But we'll see where it goes. But I think if you sit on the sidelines, you're always waiting for a better time. It's never a perfect time, and if we buy at the end of 2020, we certainly risk the possibility of something going even lower than what it was. So we're just going to try to make the right decision at the time and see if it makes some economic sense, because I'm squarely in the camp that in 10 years from now, asset values are going to be appreciably higher,
Sure.
2-3 times higher. And if you can buy something with 30% down, your multiple on the actual equity invested should be through the roof if you buy in the right locations and the right types of deals. And additionally, I think the migration that's been happening, or the economic migration that's been happening for the better part of 2 to 3 decades, where people are leaving California and the Northeast, and businesses are coming to more friendly waters like Arizona, Florida, Texas,
Sure.
kind of jump out the page. I think that this is going to further accelerate that pace of that migration, especially if we actually start onshoring jobs that were manufacturing jobs in China and other places, because, we've had a really efficient supply chain for the last, 20, 30 years. Just we're finding out today it's not very resilient, right?
Sure.
So like these things that we actually need, we can't get because they're manufactured in China, and we can't get them
Sure.
over here. So as we start onshoring jobs, the jobs certainly aren't going to go to New York State or California with all these crazy regulations. They're going to go to places that have a more business-friendly environment, and people follow jobs, and that'll continue support the housing in places like Texas, Florida, and Arizona. So I think long-term, everything's good, and I'm bullish long-term. We'll see how smart we are and how smart we were when we settled these deals up over the past 5-6 years, and we'll see if we can weather this economic shock. I thought if we could weather the one from 10, 12 years ago, we were in pretty good shape. This one's going to be worse.
Sure.
So if we can weather this, I think we're going to be proven that our business model was pretty sound a few years ago.
No, that's great. And you had alluded to your podcast for those listeners out there. Definitely check out the Old Capital podcast, particularly the Ask Mike Mondays. It's just fantastic. I listen to it every time I'm driving up to Dallas. So, you had talked a little bit about your acquisition strategy, I guess thematically through your podcast, but maybe walk the listeners through, how you think about the deals that you acquire and how that's evolved over time from when you started buying assets in multifamily.
We first started buying, what I lent on when I was a banker, and then we first started buying was a lot of workforce housing. So, 2012, 2013, you could buy, the cap rate environment in Dallas, which is where we own most of our assets and where I live, was, 8 or so years ago. You could buy a brand new Class A deal in Dallas for about a 5 cap. A B deal was about 6.25, 6.5 cap, and a C deal was like 8 to 8.5 cap. Fast forward to 2 months ago, or beginning of this year, the cap rates were for a brand new Class A deal was probably like, 4.5. B deal was probably 4.75, 5, and a C deal was maybe 5.25, 5.5. And if these deals had a big value add component, because everyone was looking for value add, you even lower the cap rates further. So basically what used to be a 3.5% spread from the top of the market to the bottom of the market, everything got basically compressed upon itself, where the brand new Class A to the workforce housing Class C deal was basically the same cap rate or within 1% or 100 basis points of each other. So as we started out, we bought a lot of workforce housing. Then we went from C's to B's, and from B's kind of A minus and some A's, because it didn't make sense to me for the last 3, 4, or 5 years, like why, especially the last two years in particular, I had to pay same or similar cap rate for something built in 1974 that I can't build something built in 2004, 2014. It just didn't make any sense to me. So we took the opportunity to sell old, take that money, trade up, buy something a little bit newer. So that's kind of what we've been doing. And then the debt terms got better and better and better as we bought newer, nicer, better stuff as well. And so that's kind of what we own. And if you look at our current collections for the last 30 days, that was a really wise move because the delinquency and what little workforce housing we have left is materially higher. And that's kind of the highest delinquencies in the 1C deal and a couple of B deals we have. That's where it's delinquent. And our Class A and A minus stuff is collected really well. So going forward, I think we probably got to go back in time, to be honest with you. I'm probably going to start looking back at the bottom end of the range and the very top end of the range. So I think the barbell is really where the dislocation is going to be. So hopefully we can buy some brand new stuff from a developer that couldn't lease it all the way up in 2 years and his bank is banging on them. We can go buy something from that guy, or we might go buy some older workforce housing stuff when cap rates, expand, because the marketplace finally prices and the risk that's always been there just hasn't been priced in for the last several years. Unfortunately, probably a lot of the newer syndicators might get, a little bit dislodged, especially if they had a bridge loan on it. And one of the things I kind of been saying here lately too is, a lot of these people have been doing some pretty tough deals too. I don't think we'll go into that space, but some really high crime stuff that I've been preaching about for years.
Don't buy in the hood.
Don't buy in the hood, right? It hadn't mattered. It just hadn't mattered for the last 4 or 5 years because everything went up. And they would just buy it and sell it 2 years later and double their equity in the deal. And they did that over and over again. Well, now that's going to matter, So I think there's been a lot of, unfortunately, newer people that bought in some really tough areas that, one of the things I've been saying is you can't be successful doing a hard deal with soft people. So if you don't have experience, you don't kind of have that tough mentality, you haven't been through the war, and you're buying a deal in a really high crime area and you've been doing this for 6 months and you have a bridge loan. I mean, I just don't think the end of that story is going to be very well here pretty soon. So I fear for a lot of those people that are in those deals,
And then what about, Section 8 in terms of mitigating some of that risk if, people did buy in the hood, but they have a large portion that's Section 8? Does that change your opinion or is it still?
I mean, I would think that would certainly help your collections. If you have some Section 8, there's a lot of stuff that goes along with it, and we never really have gone into that space. There's also the LIHTC deals, low income tax housing credits you can get, which are generally newer, nicer stuff that just in a tougher, lower socioeconomic area that have, tax abatements and things like that, which is the entire property you have to have income restricted. And that's kind of a different subset that we never really played in anything with the income restricted space. We've always been market rate. But, that might help a little bit. But at the end of the day, when these deals start trading again, you're going to buy the first deals they're going to trade. If everything's discounted, I'd rather buy in a nice, good area. Those deals have a lot more liquidity. And then once those deals get bought, then you go down to the secondary type locations and third and fourth. The deals over the last 2-3 years that traded for big numbers in really high crime areas where people just kind of loosening, they're needing to hit certain return requirements on the projections. So what they've been given on is location and quality of the deal. And those last couple, trades and that section, I think, are where the most pain is going to be, unfortunately.
That's insightful. And then are there certain things that you look for when you're buying an asset? I mean, what are the things that you get excited about, whether asset specific things, whether, location of it or proximity to other things? Maybe just walk us through the things that excite you and the things that are kind of deal killers for you.
Yeah. What really, nice, well-located deals, low crime areas, with typically suburban multifamily guys. So, and the better suburban markets that have better school districts, near employment, near retail, near major thoroughfares, kind of the 101 of real estate. We've always taken pretty seriously about it. And then we were always, looking for deals that we can create a little bit of value by doing some renovations or maybe below market rents that we can, through our efforts, increase the valuation. But at the end of the day, really what I was looking for was something that's a relative value to today's market. Because there's always a deal, right? Whether it's 2 months ago or whether it's, 4 months from now, there's going to be a deal relative to the rest of the marketplace. So something that we think is a relative value to what other things are trading at around us. So, we bought a brand new 2017 vintage deal, wrap construction. So we sold a deal, 1031, bought a brand new 2017 vintage deal. We paid 168,000 a unit at the end of 2019, and the deal right behind it was on the market and was about to sell for 215,000. And we saw that disparity in price, and we thought that was a relative value. Now that might have been slightly nicer of a deal, but all things we're just kind of looking for something that has a relative value to current market. And then we put really good debt. And so we, at the beginning of our career, put a long-term fixed rate debt on a lot of the stuff. The last several years, we've been doing a lot of adjustable rate mortgages. So we have a lot of pretty low spreads on some 30-day LIBOR adjustable rate mortgages. And now are all going to be pay rates on the twos, interest only. And I think, honestly, we'll probably see some of these with pay rates with a one starting on it. So if I could pay 2% less or an interest on an IO basis, I mean, I'm not saying we can't get hurt in this environment, but it's going to be, those deals will be a lot more resilient than something, unfortunately, that I maybe have a 4.9% fixed rate that's amortizing on a loan I put on 4 years ago that I still own that asset. So that asset will have a little bit more stress than something that has, maybe 1/3 of the debt service per loan dollar. So those we kind of learned that lesson real good, and hopefully we have that applied. And now to buy interest rate cap is so cheap today. It's basically free. Essentially, get an interest rate cap. You can hedge a lot of your risk because it appears the market believes we're in a low interest rate environment for the foreseeable future.
And then how has your financing strategy changed, from over as you've acquired assets?
Yeah, like I said, I think the biggest thing is going from fixed to floating. We've done a lot last several years, a lot more floating rate mortgages, which is paying off in today's current environment. Not only with lower interest expense, but we got a few deals that we had to suck up some pretty large prepayment penalties through the yield maintenance or defeasance when we ultimately sold them, or the buyer assumed the mortgage and we got a lower purchase price due to that fact. So that was a lesson we learned pretty good. Try to make sure we have some flexibility in our exit. It's something we're going to try to take forward. And then we've actually been low at the beginning of the cycle. For us, we had 80% of the mortgages pretty much across the board. And then as we've been going, we've been dropping our leverage. Part of that's the lenders requiring you to, and a part of that's just we fortunately we're tempted but never bit off on the poisonous apple that is the high leverage bridge debt fund program that a lot of my competitors did. So we did a deal that we could have got 83% leverage on, and we did a loan with a regional bank at 63% leverage. Wow. And so we put down quite a bit more money because it seems suicidal to go take that kind of leverage. And that was a year ago. So I think I feel a hell of a lot better today that I have 20% less leverage. And that was easy for me to say because a year ago that transaction was a 2-property portfolio and we raised $25 million in equity. So we kind of built a track record up to be able to raise some more equity. So when you're starting out, these choices are a little tougher because you got to do what you got to do to get the deal done. But I think the lesson is they just try to be a little bit more conservative, raise a little bit more money. This next go around, the lenders will force you here starting in a few months when deals trade. You won't have a choice because the debt has resets. And then when it comes back on, these terms will not be as favorable. A lot of those debt funds are basically all of them are out of the marketplace. So they're just gone. So, people are going to have to expect to put more money down. That's just the facts of life. And then they'll slowly kind of loosen up, and then we'll have similar type debt products 5, 6, 7 years down the road. Sure.
But you stayed away from bridge loans, and you said just the leverage component, so if you're able to raise the equity, then, you kind of stay away from the higher leverage.
We did take a handful of bridge loans, but they were always at lower leverage, and they were always with a regional bank versus these kind of debt funds that then go sell it, securitize, kind of like CMBS type debt funds. That tend to be a little bit more like predatory type lenders. So, I mean, in my mind, if we were going to take some maturity risk and refinance risk or sales risk, I wanted to have a lower loan to value or loan to cost. If we wanted a little bit higher leverage, you want to take a 10-year term. That you kind of one of those two levers you should pull. So if you want to amp up to the leverage, maybe extend out your maturity. If you want to have a little shorter maturity to help a little bit flexible in the prepay, maybe you lower your leverage. That was kind of the math I was doing in my head the last several years.
Okay. And then, in terms of, is there a quick way that you screen deals to kind of put them in one pile of, this is done, we're not going to spend time on it, or, hey, let's spend more time on this opportunity?
Yeah, we would go through, have kind of a back of the envelope analysis. So really, kind of deal comes in, a lot of them just are simply killed just because of location or size or something. Just like you can't physically change about it. So if it's on the wrong side of the tracks, I'm just not going to go there. So we would just terminate the deal. So that would eliminate a lot of them. The next would be kind of, okay, well, what price are you asking, and then we kind of look at that relative to kind of our history of the market. Now that's going to be a little tougher to kind of navigate for a little while as we kind of reset the marketplace. But for the last couple of years, you just kind of see everything trade and kind of have a little mental Rolodex. Plus we have pretty good notes to try to track everything. And if it's, the marketplace is, historically trading similar type deals for 100,000 and they're asking 110, that isn't very attractive. If they're asking 90 or 95, it's okay. That makes a little bit of sense. So we spend time on things that kind of made sense on that kind of gut check level. And then from there, we typically do like a back of the envelope 15-minute analysis, kind of seeing what the market rental rates are versus in place and kind of what our debt assumptions are, and then kind of what would a basic return look like. And if that was in a reasonable range, that's when we probably go tour the deal, spend a little bit more time on it, do a full underwriting that takes 4 or 5 hours and just really kind of get deeper into it. And then from there, if that still makes sense, we like the tour, that's when you kind of start making offers, make sure you're there, get some debt quotes. So it's kind of a series of like checkpoints along the way where, I found the biggest expense of my life is the biggest cost is really opportunity cost. So if I spend a lot of time on one thing, it's at the expense of something else. It doesn't feel like that right now because I haven't done anything for 6 weeks, but just kind of report the news. But, at some point when we start doing deals again, that's really it. So I think that what kind of separates the more prolific and successful people is, they have ways to say no quickly. Sure. And the quicker you get to no is the quicker you're going to get to yes with something that actually might make some sense. Great. So just trying to make sure we're judicious. And if we know this deal's never going to work for this one reason, don't spend any more time on it. Shoot in the head and move on.
And how do you work with your team to kind of siphon through that deal funnel?
We have 2 offices in my company. So my partner runs our Austin office. I run our Dallas office. So Austin's really kind of the analytical, transactional side of the business, debt, underwriting, things like that. That's kind of really done out of Austin, where Dallas is more asset management, investor relations, kind of the 2 main components that we do out of Dallas. And then acquisitions kind of overlap between the 2. So, something comes into me, I kick it to him, or if he gets, my partner Sean, if he gets it, deal on its own, kind of have our own guys that we kind of tend to work with more than the other ones. They kind of underwrite it, make sure it makes some sense, and then we kind of move forward from there. And then we have very clear delineated roles and responsibilities. So, some stuff we obviously all get on the same page before we do it, but he has his role, I have my role, and our various team members underneath us have their specific roles. So, we're pretty lean and efficient. We never really got bloated. So I feel fortunate that we're able to kind of, I think, stay intact throughout this process until we start getting back to doing deals. So, but it's just about team and leveraging people that have complementary but different skill sets to you. If you both have the same strengths, then you're not going to be as efficient or effective of a company as if you can partner with someone with a complementary but different skill set to you.
And what do you think of rent growth for this year and next year?
This year, flat to negative. To be honest with you, I don't think we're probably honestly should be negative. Hopefully negative 2-3% is probably my base case at this point. Next year, flat to slightly positive. There's so much uncertainty as we sit into how quick everything's gonna rebound, and and to what extent I don't really quite know what's going to happen in 2 weeks from now, let alone a year or 2 from now. But if I certainly don't think V-shaped recovery is certainly going to be in the card. You keep hearing about the V, the U, and the L. So I certainly don't think we're going to see a V. So it's either going to be U or an L. Where it's either going to be a year and then kind of start going back. Then every part of the country is going to be disproportionately affected and impacted. So I think, like I said, I think we'll, in Texas and Florida and Arizona and states along those lines, I think that have been outpacing within migration. We'll continue to see that as we enter into the recovery. So I think we're better positioned in the greater Sunbelt region versus kind of the Midwest or the Northeast, or certainly the West Coast has their own share of issues. Because you're seeing headlines about governors, or not governors, but congressmen and women, and people from states like New York and California and Minnesota calling for their residents to go on rent strike.
Sure.
So if I have capital, I certainly don't want to put it in a place that the leaders of that area want to talk about not paying me rent. So
Sure.
I think that would make capital flee from locations like that. On even if it's a small percentage. There's so much money out there, it could have a pretty outsized impact
Sure.
on valuations in the future.
And then in terms of submarkets and DFW, any that you think will underperform versus outperform? What are your
I think, my same thing I've been beating the drum on is, the high crime areas. So the Dallas-Fort Worth specific, South Dallas, Lake Highlands, Hickory Meadows, go to Fort Worth, East Fort Worth. Those are tougher, higher crime areas. I think that the submarkets that are well positioned, like the Collin County submarkets like Plano, Allen, McKinney, they have a little supply issue on the top of the market. But I think the workforce housing, B to A-, that'll do better in those markets. I like HEB, Hershey, Euless, Bedford. I like Carrollton. I like Irving. North Fort Worth is a favorite of mine. So I think those locations historically have done well, and they will continue to do well. They'll become the first recovery markets, and then long in the cycle will be when the higher crime areas would recover. So that's kind of my personal crystal ball of how I kind of see this coming out in Dallas-Fort Worth.
No, that's helpful. And then, just walk the listeners through your typical business plan for an asset. When you acquire an asset, what do you typically do day 1, day 30, day 90, 6 months, so forth?
Historically, most of these deals have had some level of value add to it. So, you kind of buy it. I always thought of these like a Nike swoosh. You kind of go down a little bit before you go up, or like a check mark, So you buy it, you go in, you enforce proper protocols and procedures. You kind of do some cleanup within the tenant profile, making sure you're doing proper screening, you're doing the right tenants in there that actually have jobs and no criminal background. And then as you make units kind of vacate, you go in, upgrade them on the turnover, do the exterior common areas, and start charging the higher rental rates, $100 or whatever the business model is. You go and charge higher rental rates, and over a period, usually in my experience, this entire cycle is taking about 2 summers to turn a rent roll. So depending on when you buy it. So if you buy it in July, you kind of miss that summer. So it'd be about 2 years. If you bought it in January, you got the summer of the year you bought it plus the next summer. And then once you were done that, this last cycle, you were pretty much ready to sell or refi because you already got through the rent roll, 1.5 to 2 times and effectuated the higher rental rate. So, we'll see going forward. I'm envisioning that's going to be a slower, longer slog. And then we'll see kind of where cap rates go as well. I think we're going to see at least some temporary disruption to cap rates. I'm of the camp in the long run, cap rates will stay, flat to negative just because of low interest rates and the amount of liquidity they're injecting in the system. Is going to, I think the Federal Reserve everyone's been talking about income inequality and the 1% being unfair and all that. And all the Federal Reserve policies they're currently enacting are going to do nothing but further that inequality. So they're kind of giving us the same medicine that's caused the same issue over and over again. Sure. So those that own assets that are levered with, low interest rate debt should do okay, I think, until they change the playing rules.
Well, that's great. And then, obviously you've had a great track record of success and well-known and so forth. Have you considered raising a fund, and what do you think about the pros and cons of that?
I think we've talked about raising funds. We've always done, deal specific equity raises. So, you invest invest $100 grand with us, you own, X percent of this one asset, this one location, or maybe is a 2 property portfolio. So, X percent of these 2 assets, right? But it was never like a blind pool or the fund model. The pros and cons are it's easier to attract capital when it's a deal specific raise, meaning I can tell you the pros and cons about this asset versus having to say, hey, the deal would look something like this in one of these markets, but you don't know exactly what it is. So that's one of the pros of doing a deal specific raise. Obviously, if you have the ability to have funds in the bank, it's a little bit easier when you're actually going out trying to buy deals versus kind of doing it in reverse. The risk is a little bit less from that standpoint, but you do feel the pressure if the money's sitting in your checking account, like I got to go spend it. So maybe that might make you a little bit less disciplined in your acquisition criteria. But at some point, I think it's okay to, I don't think there's a right or wrong with either of these. I don't think in whichever way you do structure, I don't think there's a right or wrong. We've always historically done with a pretty simple structure where it's an 80-20 split, 20 to the sponsor, 80 to the passives, and we don't pay a preferred return. A lot of people have been paying 6% or 8% preferred returns with like a waterfall structure where it's like, investor gets the first 8%. Above that, it's 70-30. They can choice to 60-40 to 50-50 based on our hurdles. It kind of tends. We always thought of it like it has a potential of maybe disaligning the sponsor's interest from the passive investor's interest from the standpoint that if the deal's doing really well, you could turn the deal quicker, you get a better IRR, you get more of the split. So maybe you're apt to sell the deal a little bit quicker because you're going to be in your split a little bit quicker versus maybe the deal would benefit by being seasoned a little longer, but the IRR would ultimately drop because you have more time. Or if the deal is the opposite, like maybe like a lot of these deals we're about to see, hopefully, or not hopefully, well, I expect to see a lot of these deals that if you have an 8% preferred return on your deal and you're a sponsor, you clearly are not going to be able to pay out 8% in 2020. So say 2020, you pay out 0, and then you go into 2021, maybe the world recovers a little bit, but you can only pay out 4%. So now, that pref is accruing. So now you have 8%, and then next year you accrue 4%, so you have 12%. So then you're 2022, now you have 12 plus 8, so you got 20% you got to deliver before you see a dollar out of it. So at some point, your sponsor's digging themselves such a hole with accrued pref, they're looking up, then I'm never going to get out of this deal. So maybe let me just dump it, buy or sell it because I'm working for free. So I think it has a chance of really disaligning a lot of people's interests. So not saying one's right or one is wrong, but those are some of the things that I think about when we're kind of doing it. And what's always worked for us, Ryan, is just we kept it really simple. It's always worked from the beginning, so we never really felt the need to try to deviate too much from it. We always thought it was a fair trade, and we've been able to raise capital pretty prolifically with the structure that we had.
No, I appreciate that. That's really helpful. And then turning to asset management, obviously you've done a great job communicating with investors and really on top of your assets. So what are your thoughts on self-management versus third-party property management?
I don't think there's necessarily right or wrong. I think at the end of the day, no one cares about your money more than you do. So if you're good at what you do, I think self-management is probably better in the end of the day. But with that said, it's we third-party manage. We use a company called Valiant Residential. They manage our stuff in Dallas and Austin. And we're somewhere around a third of their assets are ours. We're their largest clients. We're kind of the next best thing in my estimation is kind of being too big for them to ignore type of thing. Sure. We really view it as like a partnership. We're kind of married in these deals together, and what's good for us is good for them, and vice versa. So that's kind of what we've chosen. We have a asset manager that a professional guy that a long track record for a very large company. So he's been with us. He's been doing a really good job. So his day-to-day responsibility is looking at each of these assets on a continuous basis, talking on a continuous basis with the various team members of the management company, reviewing rents on twice a week basis, kind of setting renewal strategies, things like that. Having a lot of, oversight and kind of the day-to-day decisions that we have with all these assets. So I think, whether you have someone that can do it for you, you do it yourself, that is, critical to kind of take a good oversight onto the management company and the decisions, as well as, the roles that he serves a lot with property tax protests, which in Texas, property taxes are a very large line item. So, protesting that on an annual basis is critical, as well as kind of reviewing some service contracts and insurance renewals and things like that. So when you start out and you do this and you're kind of new in the business, you do everything, right? You do the $5 hour task, and you do the $1,500 hour task, because you kind of do everything. As you grow and scale and get some asset management fees under your belt, you can then afford to hire talent. And, we certainly feel like we have a pretty good asset manager, a lot of experience that can handle a lot of it. And then I just kind of oversee, and he reports to us on a regular basis. Really, the office is next door to me. So pretty much daily we're chatting about something for at least a half an hour, if not longer.
And so you mentioned property taxes and also throw insurance in there too. What are your thoughts on where those go this year and next year? So
we're seeing early indications on insurance. We're probably going to be 9-10%, which isn't as bad as I thought. Yet higher, which, we're thinking it could be. Last year was 20%, and this year indications were 20. I think we might be able to beat this down to that 10% range. We renewed in a little less than a month from now, May 15th, our renewal date. So we're kind of in the middle of that, but we're looking at higher deductibles, so we might have to buy down some deductibles, which will make the premiums go up a little bit more. So we're still kind of in the middle of it. So unfortunately, I think we're going to see certainly double digits increase in Texas and insurance. We have a lot of hail up in North Texas, and we have a lot of hurricanes down in South Texas. So kind of get a little bit of a double whammy in Texas. Taxes. So most of the counties should have had their taxes out by now. Most of the counties this year are going to come out next week, so the end of April, basically, with their 2020 values. In Texas, is based on the value as of January 1st. So the pre-COVID, the assets in Austin, I've actually seen the values come out, and we're in 2 counties in Austin. The Hayes County, we have 3 assets, and they came out swinging. Man, they came out with some pretty big bumps.
Oh wow!
So we're gonna like the mini. It's not that different from the last several years. Every year's a knife fight. So we got to go down swinging. We're going to protest, likely file a lawsuit in Texas, which is part of the protest process, and go. So I'm a little more optimistic that maybe North Texas won't be quite as aggressive as the counties in Central Texas, but yes, being a week, and I wouldn't put it past them to really come hit us. And I think next year will be the year that we get maybe a little bit of relief, because obviously collections will be impacted, so valuations would have to be impacted as well. But everyone's going to sue them, so everyone's going to fight, and it's going to drag on. But this is obviously with people being unemployed and the counties and cities providing more services, and this being the primary source of income in Texas, looks like they're going to come with their hand out asking for more money from all of us property owners.
Sure. And then on the asset management side, what KPIs do you focus on? You have a lot of assets, and trying to, like you said, spend your time on the things that you can add value on. So how do you?
Today is total rent dollars collected. That's today. Before this, and that's going to be the next several months. I mean, nothing else really matters but total collections, really, in the immediate term. Whether I'm 85% occupied or 95% occupied, this total dollars collected right now. Sure. Generally speaking, before that, it also was total rent dollar collected. We wanted to collect more this month than last month, but each asset might be a little bit different. Where if we bought something 3 months ago and we're in the process of repositioning it, I know I'm going to have to kind of go down before I go up, right? So we would have for some vacancy, et cetera. So we might take a short-term hit to then go renovate the unit, and then get higher rent. So we kind of look at lease trade out amount. So my old rent was at $900, my new rent's at $1,000. I might have been vacant for 45 days or 60 days on that unit, but now I'm higher, and I'm going to kind of start that momentum. So we look at that quite a bit. Obviously trying to make sure we do our best on the expense side to contain that. But this entire last cycle, really, it was about driving, lease trade out and increasing rental rates and collections. And then all you had to do was go from, the 80s occupancy to 95, hold that for about a month. You hit the market, hold that for another 2 months, and you get out of the deal and make a fortune. That was kind of the later part of this last cycle for the last several years. And it won't be quite that easy going forward for a while, but that's kind of what we generally focus on. But today is getting dollars in the door.
Yeah. No, I appreciate that. And then in terms of incentive plans, for on-site leasing staff and maintenance staff, what works, what doesn't work?
Usually a lot of it, the leasing staff, the maintenance staff is really kind of around work order, time outstanding, number of work orders have to go back and work a second time, things like that. To the office staff, again, it's about rental collections, dollars collected, and they get dinged by delinquency as well. Right now, we kind of turned off the delinquency part of the bonus, because obviously it's not their fault that these residents are delinquent. Sure. So we're just, again, trying to motivate them to collect as much dollars as possible, both with monetary, bonuses, as well as we had going into the last weekend, any property that had 5% or less delinquency got Saturday off. They didn't have to work Saturday. So if you if you had more than 5% delinquency, they had to work on Saturday. So it was kind of a carrot for them to try to get a day off.
And was that done on a monthly basis or?
Yeah, that was through last Friday.
Okay.
So whatever, I don't remember what day that was, 19th or 20th.
Okay, that's a great idea.
Last Friday was, and that was it. So whatever the benchmark is, that would incentivize them to go knock on those doors a little bit harder, try to get that extra rent check.
That's great. That's a great way.
Yeah,
awesome. Any other tips? I mean, that was a really good one.
Yeah, that's today. I think with the residents, we have payment plans, obviously we put in place. We're trying to do some like more community type stuff where they'd have like a chalk contest of who could have best chalk drawing on their front patio or whatever. Just things like that. We've been beating on the residents, generally speaking, to try to collect the rent, or the staff has been. It's been tough time because obviously they're carrying compassionate about people that just can't pay and have life interruptions. But we need to collect the rent to pay our bills and keep our assets alive. So it's been a tough environment for the residents and for the staff in particular. So trying to find some more community outreach things the latter part of the month now that the rent's largely in the door. Try to build a little better morale both for the residents and the staff. Kind of what we're thinking about actually. So, I can't think of anything else off the top of my head that works. Next month, we really, some of the things I have heard other people talk about, which I sort of disagree. A lot of people in March were saying, hey, if you pay April's rent early, we'll give you say $75 off or $100 off your rent rate or whatever, 5% off, whatever the number is. So what I think has happened is the people that were responsible, they're going to pay you rent, probably took you up on that. Mm-hmm. And so you're probably giving that 5% or $50 concession to someone that was going to pay you rent anyways. And the people that were going to be tougher to collect, they weren't in a position to pay you that rent. So I don't know if that was the best way of going about it. Here at the end of last week, as we started getting in the latter part of the month, we threw out the idea of maybe trying to go to some of the residents that still had April rent outstanding and saying, hey, if you pay April rent on your credit card, the processing fee that you would pay will apply as a credit to May's rental. We've had very little response to it, so I don't know how effective it was. Wow. But I didn't want to go throw a bunch of promotions and concessions for something that someone's going to pay me anyways. Sure. You're kind of just giving away cash when cash is king right now. You get every dollar you can in. So I think just kind of trying to think through second, third level about some of the promotions you're trying to give out. And if you're just motivating people that are going to pay you anyways, you're really just shooting yourself in the foot versus trying to be a little more strategic about it. So I don't think necessarily all the surface level ideas that some of these people have thrown out there maybe are always the best, I guess.
You had mentioned compassion early on in our conversation to tenants. What else do you think has been helpful in terms of maintaining high renewal rates for your properties?
I think the renewal rates really are just naturally elevated right now because everyone just doesn't want to move. What our leasing traffic's probably down. I looked at this about a week ago. Our leasing traffic is down probably somewhere around 50 to 60%. Mm-hmm. So the amount of traffic we're getting is halved or greater. Sure. But our actual leases are only down maybe 10 or 15%. So what that's telling me is anyone that's coming out looking for an apartment in this environment is serious. There's no looky lose anymore. So if you're coming to us, you're serious about leasing. We're converting at extremely high percentages. Now the renewals, I've seen a lot of people that have given notices that then rescind their notice and stay in their unit because people really don't want to move right now. So you're seeing much greater renewal retentions, and we're going flat to negative, which was the NMHC, National Multi-Housing Council's recommendation, which on your renewals for April and May and June to kind of be flat to negative, to try not to really push the envelope in time of need. So that certainly helps. With the residents that can't pay, putting them on payment plans, like I said, helping them find the resources for, hey, if you get a paper check for your tax refund, go to this website, put in your bank account information so you get the stimulus checked, put by ACH checking account, or hey, here's the Texas Workforce Commission, here's how you file for unemployment, or here's this other resource or that resource. So we're trying to give them some resources that we can, and the people that are willing to work with us, we're willing to work with them, but the people that are just kind of going dark on us and blocking the door and not communicating with us, obviously we don't want to make that the local news. So we're not going to be the first people to evict people, but once the evictions come back on, we're not going to, we will be less likely to do that to somebody that had truly been impacted by this, that have been trying to work through this versus someone that's kind of went dark, just aren't going to pay you. And it's going to be a really, really hard thing because everyone's motivations are a little perverted right now, especially when they realize they can't actually get evicted from their unit. They might take that as they don't care about the credit. I'm just going to live here for 3 or 4 months until the landlord can finally get me out and, screw him. Right.
Yeah, no, appreciate it. Michael, as we wrap up here, this has just been a fantastic conversation. So really appreciate your time. What advice do you have for people getting into the business, both passives and first-time syndicators?
I think for first, it's nothing different from before where you need to get a base level education. So listening to podcasts is certainly a good start. So make sure you understand, get educated. I think that is kind of the first. So if you don't understand what you're getting into is just dangerous, right? So specific knowledge reduces risk in any transaction. 2, as you're kind of coming out of it, I think kind of calling back to the basics of these deals, better located, making sure you have a capital stack set up correctly. That won't be necessarily a problem for the next year or 2 because your lenders are going to make you put prudent debt on it. So the lenders are going to regulate a lot of the structure kind of coming out of this. I don't think that'll be a big issue going forward. I think obviously anyone that can survive an environment like this is going to come out of this, generally much wiser. And these will be lessons that people will take for a very, very long time. So, I wasn't actually owning real estate in the last crash. I kind of bought it as we were covering the last crash, but I was a banker and I was a Grim Reaper, 12 years ago doing problem loan workout. So a lot of those lessons really stuck with me as I was kind of in my early 30s, doing that. Now that I'm in my 40s, those lessons kind of, served me for the last several years, the way we set this up. So a lot of people have been in this business for the last couple of years. It's not for any fault on their own, but they just weren't doing this years ago. So there's going to be a lot of lessons learned, a lot of principles that people ignored that now they're going to realize why you would do it. So I think the people that survive this will be much better bets to invest capital with in 2021 than they were in 2019, for example. So I think, those that make it around, you probably have a bunch of good options of people to invest with that were invested pre, that then didn't lose all their assets in the middle of this recession. That'd be a good target for someone to potentially invest with. And then the market will make sure that these structures are set properly because the lenders aren't going to let you get over levered. And then if you could do the basics of buying, something that has, some upside in it, or is a relative value to current market that's well located and put, good quality debt on it. I think we're going to, instead of seeing the 14, 15 projected IRRs that we were seeing the last couple of years, I think we'll get back into the 20s of IRRs here in the future, which is kind of where we started. So I think all in all, people will, a year or 2 from now, you kind of just invest with seasoned people that made it through it and well-located deals with proper leverage. I still think long-term multifamily is a great asset to invest in. And I think we're going to see a heck of a lot of wind in our sails when we actually start seeing all this money trickle through into the asset valuations. Because if you got to put about a third down or 30% down on a $10 million deal, you put $3 million in equity in the deal or so. And over the next 10 years, if the asset prices triple, go from 10 million to 30 million, that's a hell of a return on $3 million investment,
sure.
Right? So I think that's probably something along those lines of what you're going to see in the markets that we invest in, and many other similar markets to Dallas, Fort Worth, Austin. So I think the future's bright. So like I said, can you hang off for the next 12 months to make the next 10 years profits? That's really what I'm focused on right now.
That's great. No, that's awesome. So Michael, really, again, appreciate your time. How can listeners get in touch with you?
Really, I think there's 2 ways to find out more information about us. First is you mentioned I'm co-host the Old Capital Real Estate Investing Podcast with all people. So the easiest way, simply go to iTunes or Stitcher or anywhere you probably listen to me talk to you right now. You can find the Old Capital Podcast by searching Old Capital. We've been doing that for 5 or better years now. So we have hundreds of episodes archived. So you can hear me go back in time, say all this stuff I just told you today. I said it in real time a couple of years ago. So maybe
sure,
I'll
absolutely.
look smart at some point. Or if you want to get more information about potentially investing with us, whenever we actually start doing deals again, which is not currently, but at some point in the future, our company is SPI Advisory. So just go to www.spiadvisory.com. There's a contact us form, fill that out, and we're always happy to set up some time to give you a little bit more information about what we do.
Awesome. Well, Michael, thanks again for your time. Really appreciate it.
Thank you for listening to Multifamily Rockstars. We hope this episode was helpful for your personal and professional growth. For more episodes and to learn more about investing in multifamily apartments, check out lifechangingcapital.com.